The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So a key point then is the assumption of leverage is an essential product of the retail trader to trade the global financial markets. The ability to greatly increase what we call notional trade size expands our purchasing power as traders, and it is absolutely imperative that this acceptance of risk be understood and respected. What I'd like to do then is just to walk you through a hypothetical, enjoyable example of how we can best describe leverage. And the question, quite admittedly, it's a rather peculiar question. Do you know any learner driver who starts their driving lessons in a Porsche? Okay, do you know any learner driver who starts their driving lessons in a Porsche? And I can be quite honest with you to say that the answer, me personally, is no. I've never met anyone, or do I know anyone who has ever tried to start learning how to drive a car in a very fast Porsche. Can you think of the obvious reason why? Well, there's too much risk involved. It's quite difficult to trade. It's quite sensitive in its movement. Even in first gear, it would be quite rapid indeed, and very difficult to learn how to drive on. So we can use this example to actually consult the trading platform and to consult what sort of risk or leverage we decide to take as traders. If leverage is used incorrectly, it can have a devastating effect on your trading account. Novice traders blowing up their accounts. Unfortunately, this can happen. So what we want to do is, of course, and through the beginner's trading course, guys, protect you from this ever happening to you. So I'll give you an example here. We have a 1,000 euro account at 400 to 1 leverage. That allows us, guys, hypothetically, that allows us to trade 400,000 euro notional trade size. So can you think, obviously, why that might be too much? If we have it at 1,000 euros, we've saved up 1,000 euros to, to look to trade the markets, and we then go ahead and even choose 800 to 1 account. Well, we can access up to 800,000 euros of capital in the financial markets to trade against another currency pair. That's a lot of money, and you can see if I take a full trade size to that effect, and I'm effectively wrong, well, the market could potentially move maybe 20 or 30 pips, which is nothing, which can happen in an instant, and my 1,000 euros could be wiped out. So you need to know what you're trading. You need to know and aim to reduce leverage. You need to know the risks involved with leverage by choosing trade size. So what we want to do is aim to reduce this leverage as much as possible when trading, and learn how to drive in a more suitable car, just like our Porsche example. So why not learn to drive in a Fiat Punto or a Ford Fiesta, something more reasonable to trade, and you're going to be a more effective driver over the long run, just like trading on a much more practical account with less risk. So let's then put this into practice then and discuss the practical elements, or the elements of practical trading here. We have pip and pip location, the spread, leverage and lot size, which we'll be going into a little practicality on, margin, which is simply the amount of capital that will be held on your account as risk. So that's important to note as well. So with pip location, a pip is the smallest incremental price change of a financial tradable asset. So what does that mean? The smallest incremental price change. Well, the smallest increment is really the smallest pip that the market can move. So if we look at our example here to the oil market here, we have $61.88 per barrel. Okay, so $61.88 per barrel. Well, we know $61 is the price there with 88. So the smallest pip there we can see is the last decimal place. So if this effectively moves up 1 pip, well, it's going to move up 1 cent to the second decimal place there to 89. So effectively the pip in this market is to 2 decimal places. Okay, So it's the smallest incremental change here. With forex pairs, most forex pairs are of course 4 decimal places. So this will be the pip change here, the pip value from 2 to 3. That is the notional value at which these markets move in terms of pip gains or decreases. So we need to know what our risk is in reflection to the pip value. It is important to know the value of each pip of each market you're interested trade, as they can vary drastically. So that's very important. Some markets, of course, the forex markets are more expensive to trade. The commodity markets are much more expensive to trade per pip than the forex markets. Knowing and understanding pip location is essential for calculating risk and trade size. Okay, and pip locations can range then from 2, 3, 4 decimal places. So this is something we'll be going through more practically in the next few lessons, particularly with the practical lesson tomorrow, when we'll be looking to place a few trades with pip sizes across different markets. What is the spread? Now, I'm sure many of us have heard the spread before, but what is it effectively and how does it affect our trading? So the spread there is the difference in price between the bid, and that is the price you can buy a market at, and effectively the ask price, which is the price that you can sell a market at. Now that might be a little peculiar for some of us. Why? What do you mean? What do you mean there's a difference in price that we can sell the market and buy the market at? Surely if the market's at 61.88, we can buy and sell the market at that price. Now that's unfortunately not the case. And simply that's just the cost of doing business and trading these financial markets. And it's no different than looking to invest in shares. Of course, you pay transactional fees or any other trade you'll be looking to do. Best bid then is the best or lowest price a trader can buy the market at any given time. And the best offer or the ask price is the price sellers offer the market for any asset at a particular. So the best offer price. We call it the offer simply because, well, those sellers who potentially are looking to sell their positions, or maybe they own some of that asset, they're looking to sell that to the market. They're looking to offer that to buyers. So that's the best offer or best ask price, the best price we can sell a market at. There is always a cost to trading the financial markets. That is very true indeed. The spread asks the trader to effectively pay a small premium between bid and ask as a transactional cost to each particular trade. Okay. So of course, there are very, very small commissions when we look to trade these markets, given the opportunity involved. And there are very small deviations between the bid and ask spread, which simply is a cost per getting into these markets just for transaction. So the spread cost is actioned both when a trader enters and exits a trade. So when you enter the market, you'll effectively in a forex pair be charged 3 pips. And then when you look to hopefully profit that, exit that for a profitable trade, you'll be charged a small 3 pips and premium for exiting the trade as well. So over the long run, as a profitable trader, of course, it does not affect your overall performance. The spread cost varies per market and asset classes, and traders should be aware of what they are and the cost associated. So there are more exotic markets that are more expensive to trade, and obviously that is reflected in the spread. Now, one very key point to point out here is that illiquidity will cause the spread to widen, while highly liquid markets will generally have very tight spreads. Okay, so when we discuss illiquidity there, we defined it as, I suppose, a lack of participation between buyers and sellers in the market, and that led to variance of price discovery, where buyers can't offer the market to either buy or sell at a preferred price. There's going to be more liquidity, and that's reflected in the spread as well, where something that was maybe 3 pips has to widen to 6 pips because it wouldn't be profitable in terms of proper execution. So we'll talk about that again in more detail. Institutional trading here is different in terms of the setup, and this is what we're looking to actually practically analyze in terms of how we trade the markets as retail traders. So let's discuss this in a little detail here. Here we have what's known as institutional trading ladder, and this is the S&P 500. So I'll just discuss this in a little detail. Here is, of course, the price here. This is the price here, moving from high to low, where the current price is, of course, an interaction between buyers and sellers. Okay, so effectively what I'll do is just highlight our buyers here and our sellers, offering the price. So 759 sellers are offering the market at this price. 124 buyers are looking to buy the market at this price. And if you simply want to enter the market now at market execution, you will look to buy the market here. Okay, and that will effectively take one of these orders, changing this to 758. So that is how we look to actually trade on an institutional level. Now we need a large amount of capital to do this, thousands and thousands of euros to trade these assets, and there is very high transaction costs simply for placing that trade. You may get charged S&P 500. I believe it's around $2.86 for one lot in the institutional trading platform. Okay, so here on our market watch, of course, this is the retail trader. Now we don't have the access to capital that the financial institutions have, but what we do, thanks to our brokers offering the platform to us, is that we can access leverage to look to trade these markets. So instead, what we do is offer the broker a small deviance of pips. So here we don't have the bid and ask quoted like this on the left hand side. We have two prices quoted here, such as this, where we have the bid and ask. We can't effectively buy the market at price, like here in our first example. We have to pay a small premium, which here the euro pound is 88.512. That is the best price we can buy it at. And of course, the ask is the best price sellers are willing to sell it at. So that's 0.88537. So effectively, the difference there is the spread. And as we compute, it's simply 2.5 pips. So it's nothing too crazy. You know, it's not going to cause us a lot of heartbreak. It's effectively, in terms of a transaction cost when we enter the market, likely from a 0.01 lot to cause us 2.5 cent on the euro or on the dollar, depending on how we're trading. So the CFD broker quotes these prices in line with underlying markets. These prices will move according to the market movements, and we simply pay the small spread as we enter the market. So it's just part and parcel of trading, guys, and something we have to deal with, okay? But again, if we're looking to trade consistently, we don't really take this into account, the fact that we pay small pip exposures. So let's move on then to discussing leverage with lot size. And again, it's going to be quite enjoyable because it's going to actually involve the MT4 trading platform. Guys, this will be the first time we'll be viewing the MT4 trading platform, the first time of many throughout the beginner's course. So please ask questions if you have any questions going out through the next example. So what I'll do then is move forward with our favorite trading broker, of course, JAFX, and they offer a wide range of different assets to trade from. So what I'll do is just explain leverage with lot size by observing the oil market. So here we have the oil market here. On the right hand side, it's simply quoting the price. So this is effectively the best price that we can look to trade the market. So this is the price chart. What I'll do is just annotate this in a little detail for you guys. Effectively, we're seeing a sort of bit of a rocky bullish trend to the upside. Okay, so that's over the long term. Again, this is here is highlighted as D1 within our green square to the top here. D1 actually highlights to us that is day one. So each of these candlesticks there, as discussed in lesson 2 with the structure of Japanese candlesticks, they represent 1 day. So each of these is 1 day. Now what I'll do is just change that. I'm going to use my zoom in function to actually zoom in on some price action here, and then I'm going to change that to 5 minutes. This here, again, I'll just select this in green just to highlight. I've just selected M5, which is minute 5. So that tells me that I'm actually observing, zooming in, that all of these little candlesticks, this one, this one, this one, this one, all of these candlesticks are all 5 minutes. And what I'm going to do is place a few trades with different lot sizes just to show you the level of exposure that you can access in the markets and how we can be responsible. And the best example to actually do this is simply to place a few trades and also to show you irresponsible trading, and then you'll get a level of how this is explained. So here at the bottom, what I'm going to do is highlight, this is what we call our trading terminal. I'm just going to highlight this position here because this is where effectively I'm going to place my trades. okay, in our green square, just to the bottom right of our trading screen. So effectively what I'm going to do to this market is enter 3 orders. I'm going to open our new order box, which just pops in here. This is our volume, and I'm going to trade 0.01. Effectively, I'm going to buy this market with a 0.01. So that effectively is allowing me to purchase 1 barrel of oil at that price. And I'll click buy. So there we have effectively entered the market there with the small spread. The spread there in the oil market is, of course, this is the US oil, so 10 pips. So effectively, we've just chosen to buy this market, and it's just trading. It's not really doing too much trading. You can see it's moving a small pip for pip. So then what we'll do again is go to new order. The same screen opens, and we will trade a 0.1. So again, a fraction of this, and we'll look to buy the market here. So the same trade, but you can see that we've effectively taken a much greater level of risk. As the market moves per pip, in our 0.01, it's moving 10 cent per pip. In our second trade, where we've accumulated more risk, it moves $1 US per pip. And again, what we'll do is insert a new order just to really show you the level of exposure we can gain here, irresponsibly trading, perhaps as a full 1 lot, which is perhaps 1,000 barrels of oil. We'll look to buy the market there. So effectively, that has cost us €100, which is a huge amount to enter a full 1 lot in the market. But of course, as the market moves, we are gaining a much larger level of exposure to the market again. So this is effectively moving at €10, $10 US per pip. So you can see the difference. These are effectively from 1, 2, 3, guys. This is effectively the same trade. We are long. We have bought the oil market at roughly the same price. It's effectively exactly the same trade. But can you see how people react differently when they have taken too much risk involved? If this moves against me even a little when I trade my 0.01 here, it may go to minus $2 US, but over the long term, well, I see this going back up to $70. So it's a good trade. I don't have that luxury if it goes to minus $200 US in an instant. So again, always be aware of leverage. These are the different lot sizes. We traded there as 0.01, 0.10, and a full 1 lot. And you can see how the market is moving in relation per pip to the amount of risk exposure that we have taken on those individual trades here. Again, just to highlight the different trade size, you can always consult your trade platform here. This is our trade size here. A 0.1 lot, a 0.01, and a full 1 lot there in the market. So I'll just leave that, and maybe I'll come back to that towards the end of the lesson to show you the pip exposure and potential gain or loss on that trade. So we'll move on then to discussing then is margin. Very, very important, margin again. Margin is the requirement. Margin requirement is the amount that will be taken from your account and held as a deposit when a trade is open. So for me on my account there for trading those 3 separate trades in the oil market, of course, they're all at 3 different trade sizes. That will require a certain amount of margin on account, and I'll show you that again towards the end of the lesson. Different markets have different margin requirements, so be mindful of this. Take care of this. So it is more expensive to trade the oil market than it is a forex pair. It is more expensive to trade Bitcoin than it is a forex pair, but obviously the risk and the gains of potential is much more ludicrous. So always do take these risks into account. Margin is a part of your net floating balance, whether it's positive or negative, whether it's in profit or loss, that will float into your floating balance. It can become a barrier to trade. So effectively, because margin actually takes some of your capital as risk off the table, if you have 10 open positions at any one particular time, potentially on a small account, that can become a barrier to trade, where you may not be able to make more trades because all of your capital is tied up in existing positions. Margin can become a sizable amount of your account balance depending on how many trades you have open and the size of those trades. And we'll show that again towards the end of the webinar in relation to what type of margin we've actually took or has been held on account from our 3 oil trades. Used margin acts as collateral or a good faith deposit for the open position and is essentially locked away until that position is closed. Once trades are opened, the required used margin is deducted from your usable margin until that trade is closed. Okay, used margin is calculated dependent upon the size of the trade. Again, the size of the trade simply is the leverage or the lot size you decide to trade with. So again, we have our table here, and this will explain nicely to us lot sizes and trading with leverage in result to margin. So here we have our one standard lot, okay, one standard lot size. So that is effectively the full one standard lot is a 100, okay. So in relation to that, what does that mean? Well, for Forex pairs, it's 100,000 euros of base currency. So for trading euro dollar, we are trading 100,000 euros against the fluctuating exchange rate of the US dollar. Okay, so that's our trade. That's the minimum trade size we can take. Okay, well, that's quite large, of course. And the pip location for the Forex pairs is 0.001 to 4 decimal places. Okay, the margin requirement for that is simply a small fraction of the percentage on account for your Forex pair, your Forex trade. Japanese yen are slightly different, those Forex pairs, just because of the pricing structure of the Japanese yen. It's still 100,000 euros base currency. Again, the smallest incremental change is actually 0.01. So we may have the yen priced to the dollar 131.01, simply priced to the smallest incremental change of 2 decimal places. And the S&P, which is an equity index, again, one standard lot is relative to 100 indexes. Okay, just like the previous example where if we talk about commodities, one standard lot is relative to 100 barrels of oil, and 0.01 lot here might be relative to 1 barrel of oil. Okay, so relative to one index, the minimum trade size is of course the 0.011 index, and the S&P is actually priced in quarter points. That's how it's priced in global financial markets. Okay, so that's how we trade it. So again, it's all relative to the market you're deciding to trade in terms of the leverage effect. So what I'll do is just tie all this in together just by jumping back to our JFX trading platform, trying to observe these markets again. What I would like to do then is just to reiterate again and highlight to you the leverage effect in terms of trading. Effectively, what's going on here? What did we decide to do? And just to recap, well, we took 3 long positions in oil. And they're all different. One is a 0.01. One is a 0.1 lot. And one is a full 1 lot. So effectively, that's going to be 100 barrels of oil, 10 barrels of oil, and 1 barrel of oil, fluctuating on the price increase or decrease of the underlying commodity. So you can see how the profit is changing. And obviously the larger risk is changing at 10 US dollars per pip, and vice versa as a percentage of the actual market trading. Okay, again, this is all detailed here within our actual trade size, our terminal, and this is how we can monitor all of this as well. So again, we're actually accessing a large amount of exposure. Leverage is the multiplication factor for trading these markets. We can use that to our great advantage to enter the markets. Again, all we need to do, guys, all we need to do is be responsible in managing the risk, and we'll be absolutely fine, because we can have faith once we start to learn trading strategy and the skills necessary that we can profit over the long term, as opposed to trying to gamble and make very large trades in a short space of time. Okay, in relation to margin account, well, what we can see again is, guys, is we have 3 open trades in the oil market. Because we've taken quite a large amount of risk, effectively the total position, guys, if anyone can tell me what it is a full long trade across these three trades, we are long 1.11 cumulatively, okay, in the oil market. So this is going to require a certain amount of margin on account. What we can do is just consult the figures down here. So the balance on this demo trading account is $7,696 and 47 cents. Okay, the margin that we've actually held on account is relatively small for these trades. We haven't paid, but we have effectively provided to the broker $375.63 for margin to actually look to trade these markets. So that's a relatively good amount of margin stowed away there to look to trade these markets at 375. So we can actually look to trade and get involved more actively in the markets. But again, do be aware if you're taking 10, 15 trades at the same time that this level of margin will be exceeded or will be much greater. So you do need to be aware of the amount of risk related to the margin stowed away for the broker in terms of accepting more trades and having a healthy floating balance throughout your trading account. Okay, so that does bring us to the end of the webinar. I hope you enjoyed it. There was quite practical towards the end, so great to discuss leverage in so much detail. What did we learn and conclude throughout this webinar? Well, how we can analyze the markets, whether we decide to become technical analysts or we prefer fundamental trading, or perhaps we'd like to involve some sentimental trading in there as well in defining the relevance of strength between buyers and sellers. We learned how to appreciate market characteristics. So again, volatility, liquidity, the risk involved in terms of leverage and lot sizes and trading, and then the practical elements to trading. So things like the margin call, different trade sizes, how to actually place trades on the platform there, pip location, pip gains, very practical elements again. And we'll look forward then to webinar 4 tomorrow. Our first practical workshop lesson in this beginners trading course, where we look to get involved. We'll look to observe Japanese candlestick structures. Let's see if we can get some interesting trades based off the Japanese candlesticks, whether they provided some very strong signals for price movement. We'll look to trade with different trade sizes as well, and we'll get stuck in a little bit to trading different asset classes, not only the forex pairs but some commodities as well. So it'll be very exciting lesson indeed. So that does conclude our webinar today. I wish you all the best then, and I'll see you at the same time tomorrow. So that's all for now at Forex.Academy. Thank you very much for joining us, and I'll see you soon. Bye for now.